Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for October 7, episode 311. I'm Dean Croak, Market Analyst here at DAT, along with co-host Chad Kennedy. No guest today, but we've got a lot more to cover with Chad about bid season that's just started and some of the trends he's seeing in the contract market. But of course, Chad, big news is you've got another hurricane coming your way.
Yeah, we've got a big one bearing down on us. Hurricane Milton just upgraded to a Category 4. We're hoping and praying that it calms down a little bit before it makes landfall, but it's really tough news for these folks on the coast here. Around St. Petersburg, Clearwater, that whole area really took it hard with Helene, and they're still trying to clean up from that storm.
Yeah.
So I was watching the local news last night, and they still have couches and beds and stuff out on the street that they're waiting to get picked up, and the storm's bearing down on them. So they're actually advising people to carry the stuff back into their garage if it can't get picked up. And I saw police escorts for dump trucks trying to get the dump truck capacity in there to move all this waste out before the storm hits. But the storm surge is very, very dangerous. Heed all the evacuation warnings, everyone please. And that's where the fatalities happen with flooding and storm surge from the water. But I'm about 25 miles inland, so we're pretty safe from the surge here. People will evacuate to our area here in Lakeland. So we just kind of batten down hatches and bring everything in, put some sandbags down where needed. I use mulch because I can reuse that later, but just try to prepare as much as you can, get some food, get some generators ready, and pray.
Yeah,
that's about it.
So Category 4 is it's 150 mile an hour winds, right? Sustained winds.
Yeah. It's major. It's devastating.
Have you seen anything like that personally?
I've not been hit by a Cat 4. I think we've been hit when I was around the Orlando area by some 2s, close to 3s, and I mean it'll keep you up all night, and it'll keep you on the edge of your seat for sure. Yeah.
And of course, if it tracks a little bit further north, it'll take it over the Bend area, right, where Tallahassee got hit by Hurricane Helene.
It would have to take a hard turn left to do that. They're predicting it to run right along I-4. So I-4, if you're not familiar, goes from, I know you are, Dean, but it goes from Tampa through Orlando to Daytona. So a little bit northeast trajectory there. So it could cause a lot of damage. I know Orlando was hit really hard last year with Hurricane Ian, a lot of flooding. So, and it's right now predicted to remain a hurricane over the entire state of Florida until it gets out to the Atlantic. So,
right. Yeah. And of course, we're still recovering from Hurricane Helene, that devastation up there, road closures, tragic death toll. I-20, I-26 and I-40 shut. So we've got some fairly big impacts on the freight market that we'll get to as we get into our market update. So, we'll bring Chad back in a little bit later to talk about some of the news he's got on the contract market bid season and some of the trends there. But let's dive into our market update and some of the key trends that we're seeing in the spot market. Line haul rates definitely starting to make a move upwards. There's a definite inflection in the market that we've seen in the last few weeks. It's been sustained even before the hurricane of last week and the ILA strike, although the latter didn't make much of an impact on the freight market. It was only a 3-day strike. Southeast market, of course, were hit fairly heavily. We'll talk about that a little bit later. The ISM PMI came out last week. It's a closely watched measure of US manufacturing. It held steady at 47.2. That's the 6th straight month it's been below 50, which in a diffusion index indicates a continued contraction of activity. Although that anything above 42, the ISM feels is more of an expansion. LMI, Logistics Managers Index, put out by Zach Rogers, came in at 58.6. It was up 2.2 points. The August reading was 56.4. So it's up slightly. It's the highest level in 2 years, though, which is really good news. The overall index has been up for about 10 consecutive months. Zach believes this is strong evidence that the logistics industry is back on solid footing. ACT Research truck orders came out substantially last month, up substantially. Of course, new order books opened But the preliminary estimate was even stronger at 37,100 units. That's about higher year over year by about 0.3%. Imports were out over the weekend, remained flat in September, not surprising. They came in, though, at the highest ever recorded in September at 2.622 million 20-foot equivalent units. As you'd expect, Savannah volumes were down, New York volumes were down, Gulf Coast volumes were down. But West Coast volumes were up slightly. So, yeah, definitely an impact of the ILA strike on some of the late volumes there in September. In this week's market update that'll be out this evening at dat.com/market update, we're talking about pumpkin season in Milton, Illinois, the pumpkin capital of the world. The ATA tonnage index is out. We're talking about some of the potato production coming out of Colorado and the latest on the ACT Research for hire truckload ton index. All right, let's start with the load-to-truck ratio. The 3-day International Longshoremen Association strike and the devastating Hurricane Helene caused a surge in load post volumes, up 17% last week. Carrier equipment post down 22%, load-to-truck ratio up 20% to 4.51. The 36 ports that were located in 20 freight markets along the eastern Gulf Coast accounted for about 18% of our weekly load posts last week. In the week leading up to the strike, eastern Gulf Coast combined load post volumes were up 8% week over week as shippers moved volume out of those markets. Last week, the increase was 5% lower. In the refrigerated market, the number of reefer load postings nationally up 17%. Down about 15% compared to last month, though. Number of carrier equipment posts was down also, load-to-truck ratio up to 6.31. A lot of impact in the flatbed market, not surprisingly, as a result of the hurricanes. Last week, the number of flatbed load posts was up 12%. That's 23% higher than this time last year. The flatbed load-to-truck ratio was up 27% to 15.72. That's the highest the flatbed load-to-truck ratio has been in 3 years for week 40. It's also the 7th week of gains. Lots of activity, of course, in the along the Gulf Coast in Houston and New Orleans. Load posts are up 27% week over week. And after being flat the week before Hurricane Helene, flatbed load post volumes were up 14% week over week in the Southeast region. Up 23% week over week along Florida's Big Bend, and jumped 68% week over week in Tallahassee, where Hurricane Helene made landfall. So lots of impact there. We see this pretty much on cue every time there is a hurricane in that part of the country. Again, we'll see more of that activity next week once Milton makes its way through the markets. Having a look at our euro, you look at spot rates. Last week, dry van line haul rates increased nationally by 3 cents a mile to $1.65. Remember, folks, these are line haul rates excluding fuel. There was a decrease in available capacity, of course. In the larger Atlanta freight distribution market, rates increased 7 cents a mile to $1.53, despite a 3% decrease in load volumes compared to the previous week. In the Southeast region, which was mainly affected by Hurricane Helene, inbound and outbound regional rates were up 10 cents a mile. The ILA port strike led to a 7% decrease in volume in the largest port on the East Coast in Elizabeth, New Jersey. Spot rates are up 3% in that week. According to our top 50 lanes, spot rates were up 4 cents a mile last week to $1.99. That's based on the volume of loads moved. The top 50 lanes are currently about 34 cents a mile higher than the national average. In the refrigerated market, line haul rates were up a penny per mile last week to $1.97 on a 2% decrease in loads moved. In the Southeast, spot rates rose 14 cents a mile to an average outbound rate of $2.31. In the larger Atlanta market, spot rates increased by 10 cents a mile to $2.13 on a 7% decrease in volume. With Hurricane Milton coming in, I expect our largest spot market lane between Atlanta and Orlando will be incredibly volatile this week. Reefer spot rates are about $1.97 this week. That's about 6 cents a mile higher than last year, nearly the same as the 3-month trailing average. And lastly, in flatbed, line haul rates are up a penny per mile last week. National average was $2 a mile. That's only the second time in 3 months that flatbed rates, excluding fuel, have been over the $2 per mile mark. Line haul rates are about 11 cents a mile higher than last year and about 10 cents a mile higher than 2019, and identical to the 3-month trailing average. All right, so let's have a look at our short-term forecasts. We're starting to see some inflection towards the end of the forecast here as we get into some seasonality. These are our short-term forecasts that go out 35 days. Our flagship ratecast product is in green. That's our 35-day forecast. The blue line, of course, is the actual rate view rate that's been recorded. The orange and red lines are the upper and lower forward-looking error bands as displayed in our product. And the blue is the 7-day weighted average for loads moved over 550 miles. So line haul only, remember that. So let's start with dry van. Top 50 lanes, breaking it down, they're averaging about $1.99, as I just covered. They're forecast to decrease slightly this week to about $1.97. And before starting to bottom out, as you can see on the forecast there with the green, you can see it bottoming out in the next week to 10 days before we head into an inflection upwards in the market. Again, that's fairly normal as we head into retail shopping season. That includes key sales events. Of course, we've got Amazon Prime shipping, I think, this week. We've got Columbus Day coming up, Halloween, and Veterans Day. So we start to see a lot of e-commerce moving on some short haul lanes there. The high band has got rates up about 2 cents a mile out to 9th of November. Worst case scenario has got rates down about 6 cents a mile, but ratecast is looking at about a 2 cent per mile drift downwards before we start to see that inflection upwards. Refrigerated, as you can see here, a lot more volatility, and you can see the inflection point getting towards the end of the forecast range. That's pretty much exactly when we see fresh turkey start to move out of the Midwest. Christmas tree shipping starts to get very busy in the lead up to Thanksgiving, and of course fall produce intersects with both of those prior markets. You can see ratecast has got rates up about 3 cents a mile out to 11.9. The high range in the amber color is up about 8 cents a mile, best case scenario. Worst case scenario rates down 2 cents a mile. But all of those models agree that we're going to start to see that inflection in seasonality pretty much right on track as we get to the start of November. Again, flatbed is heading pretty much to where it was last year. The green ratecast forecast is predicting rates will end pretty much exactly where they were last year. Last year, flatbed rates bottomed out at $1.83 right before Thanksgiving, before starting their upward move towards the end of the year. So that's our forecast for this week. Let's have a look at what Chad's got going on in the contract market.
Yeah, thanks, Dean. So as a reminder, everything Dean just reported on is from a broker to a carrier perspective in that spot category. So what I'll share here is from a shipper's buy perspective, buying from brokers and carriers. Starting with the spot premium ratio for dry van rates. This goes back to 2016. Spot premium ratio is the premium for spot rates compared to contract rates. So when this metric is negative, that's a signal of a soft market. And you can see we've been in a soft market for a little over 2 years now. And so we're still at negative 10.8%, continued downward pressure on those spot rates compared to contract rates. If we look at some new contract rates, or that new rate differential here in blue, this is the percentage difference between new contract rates that we've detected in our data versus those rates that they replaced. So it's a signal of the results of shippers' RFPs. We see the most recent data point here at a positive 1%. This is a potential signal of some rate increases here coming in. This runs around 10 to 15% of our total data on any given week. So this might hang up there a little bit and then go back down. We'll see. You can see that it poked its head up above zero a few times over the last year or so. So we'll keep a close eye on that and see if contract rates continue to go up. And the contract rate index here in purple is just measuring all contract rate index. This is about 80% of our shipper data. And then you can see it's just kind of just dragging along this trough, very flat, and still not making a move upwards. This is the last metric to start to move upwards of the three that we presented here. So on to reefer or temp control here, spot premium ratio also negative at negative 7.9. We have seen over the last couple of weeks the new rate differential, those new rates entering routing guides pop up over 0%, but it's been short-lived. Now we're down to negative 0.6%, and that contract rate index still dragging along the trough, and almost a slight negative trend there, continuing down. And then lastly, flatbed, our most volatile metric, as you would expect from seasonal and short duration lanes. That spot premium ratio in yellow at negative 6%, and new rate differential at negative 7% with a downward trend contract rates still dragging along that trough. Got a couple extra bonus slides in here for you this week. The percent of contributor spot loads. So this is, again, still from a shipper's perspective. This answers the question of a shipper's total portfolio, what percentage of that freight do they run in the spot market? And a spot market for a shipper is typically procured through their TMS load board or going straight through brokers, that sort of thing. Picking up the phone, as we used to say, dialing for diesel. Not sure if that's still a thing. Procuring through email. And so you get the point there. So what's interesting here is you notice the low points over time here have started to increase through the different troughs of the market. So as the years have gone by, as we've gone through these business cycles where the high points are where the market is tight, the low points are where the market is soft, shippers are procuring more and more freight through spot. And so one of the things that we've seen, and as we talk to shippers, is that they're becoming more and more comfortable with procuring in spot scenarios as they understand their segments of their freight, meaning which portions of my freight should I procure via spot and not try to include in a long-term contract bid. So we're seeing some shifts. There's some other technological shifts in that space that we've seen as well. So that's a wrap on the shipper metrics, Dean.
It's interesting. I was looking at your chart there. So you can see the 16-17 period there, and then the 18-19. If you look at particularly 16 and 19, 2016, 2019, you can see more of a 90-10 spot to contract ratio, which is what we always thought the market was. But since the pandemic, you can see a definite upward trend, but it's been sustained at much higher levels, to your point about shippers being much more comfortable buying from brokers, whether they be in the 3PL or just straight out brokerage transactional space.
Yeah, that's right. I think there's been some technological changes that have kind of pushed in this direction as well, with direct connections via API from a shipper to a broker.
Right.
So a lot of what we hear, some shippers, if I had to guess, I think it's around 20% of the shippers that we talk to, which are larger enterprise shippers, are starting to test connecting their TMS via API to several brokers. So as they move through that routing guide, through their tendered contract rates, instead of going direct to the load board, they'll first make a quick blast via API, test those API rates from the brokers. If they meet certain thresholds, they'll accept them and move them. If not, they'll move to a load board. That load board is a manual process. So if they can get that freight moved with that API connection direct to a broker, it's a little bit more efficient for them.
Right. Okay, so let's get into our topic we wanted to cover today. Bid season has started. October the 1st was how some of the big carriers look at the 3-month bid season. What sort of trends are you seeing the early part of October?
Yep, you're right. It has started. This is the heavy season when shippers are preparing their bids. They're starting to run their analytics, pull their bid lanes out of their data, and send it out to the carriers and brokers to start analyzing and bidding. And then there'll be typically maybe a couple of rounds. So this whole process usually takes anywhere from 3 to 6 months. Believe it or not, these are the large annual bids for freight. So normally we see these loads start to execute around late Q1, early Q2, March, April timeframe, when we see these loads really start to materialize in the routing guides. So we see a spike in those replacement rates that I was showing earlier in a graph. I think a couple of trends that we're seeing, to answer your question, Dean, one is shippers have gotten much more intelligent about how they segment out their freight. As I was mentioning before with spot freight, pulling that out of the bid, instead of bidding a lane that only runs 1 to 3 weeks out of the year, they're intentionally planning to procure that via spot. Whereas in years past, they may have included that, try to sneak it into a bid and hope to get some acceptance rates, but I think that they're more comfortable now. Spot's not as much of a 4-letter word as it used to be. It's just a strategic way to buy certain types of freight. But in large part, a lot of this freight, around 70 to 80%, depending on the shipper, is regular route freight, and it requires a drop trailer. And so it's drop trailer on the pickup, drop trailer on the drop. And it might be 2 loads a day. And so that's like the best type of freight to include in those annual RFPs. So that spot procurement's an interesting segment. I talked about the API rates. There's also a new trend in testing out index-based pricing. So that's a little bit different than the API rates. That's pre-negotiating with a broker to accept some future loads when the timing and volume is uncertain. So it might be something like this. I'm going to run 50 loads at some point in the next 3 months. It's going to run for about 2 to 3 weeks. Let's agree now that I will pay you the rate view rate plus 2%, for example. And so that's index-based pricing. We're going to pay you based on an index. You're going to go out and get the capacity and secure this. And that avoids a lot of headache for the shipper. And it gives the broker a little bit of an edge in being able to compete with that shipper and get some of that freight.
Right. You mentioned live loads and drop and hook loads. I'm not sure you mentioned live loads, but so how does the bidding process work for live loads as distinct from drop and hook?
Yeah, so back in my day when I was procuring broad brush strokes, my large asset-based carriers down to my mid-sized carriers can support that drop trailer on both sides, reoccurring lane rates. And then on the other end of the spectrum, my brokers and smallest carriers are going to support that live load freight. Going back 10, 15 years, the asset-based carriers would haul some of that live spot freight. It's very rare now for those large asset-based carriers to move any of that freight. It's almost all through brokers today. So I think the large asset-based carriers have gotten smarter about getting more capacity focused on dedicated type routes, if it's not a dedicated fleet altogether. And so that live freight, you can put it in an RFP and pre-negotiate it ahead of time. You're probably going to get more competition from that broker segment, where they're utilizing that capacity of smaller owner operators who have one truck, one trailer. What they want is longer haul live load, where they can maximize their revenue per day and not have to drop any equipment. So you can put that in an RFP. It's very difficult on the flip side to procure any drop freight in the spot market because your asset players don't really want to pick up that spot freight, and it's already been exhausted through your routing guide. So you've gone through the tendering process of those pre-arranged contracts. Usually this is when volume spikes on a lane. So all your carriers that you awarded the freight to have maximized their capacity and their commitments, and now you're exposed to the spot market with a drop trailer is really difficult. So being able to pivot and convert that to live load is very helpful to be competitive as a shipper procuring in the spot market. But that can be quite tough. You gotta work with your local plant to be flexible to be able to pull that off and live load those trains.
Yeah. At DATCon last year, I think we produced a slide, and you might have spoke to it, or Chris Kaplis, about the percentage of loads that move on lanes, like the volume and the spend. Can you speak a little bit to that? Because I was kind of surprised that so much volume moved on so few lanes when it comes to an RFP and all of the different lanes you could run.
Yeah, you're testing my memory there, Dean. That's a good one. I do know if I had to make my best guess, it's something like an 80-20 rule that 80% of your lanes are 20% of your volume. Right. And so I'm not sure exactly what the stats were. It might have been 70-30 or something like that. But the point is that those regular route lanes that I talked about that are included in the RFPs that are most often drop, that's going to be 20% or sorry 80% of your volume. And then that 20% of your volume is on 80% of your lanes. It's those unique sparse lanes. And they're more difficult to procure. There's a lot of uncertainty around those, and they often end up in the spot market.
Right.
Yep.
Yeah, I think I remember talking to some shippers, and they were, to your earlier point, talking about strategically buying in the spot market to try and avoid a tender rejection, because their view was that any sort of, if it's one load a month, that was almost going to generate a rejection because the big carrier didn't have an asset in place, was more likely going to go to the spot market. And that's what they were saying they were carving out of an RFP rather than asking a carrier to quote on every origin destination pairing. It was really just the high volume lanes where they needed the capacity.
Yeah, and there's some other strategies, some older strategies to kind of handle some of those sparse lane procurements, matrix rates they're often referred to. So that would be typically bidded to a broker, and it's taking your low volume lanes, your sparse lanes, your infrequent lanes, and bundling them. So at a 5-digit zip code pair, that might be 1,000 lanes in a large shippers network. And then when you bundle them at the state to state level, now you've got 200 or 200, maybe 50 lanes that you're bundling up, and you're kind of trying to combine that freight and bid it out to brokers. And that's usually at a rate per mile level, because the distance is going to be different on every lane. So those are usually backup rates in a routing guide. So maybe you've got a few carriers that have bid on those lanes, but you put those matrix rates in there to avoid going out into the spot market and that manual tender. Right. So
I've just I went back and quickly pulled up the DATCon presentation from last year, and of course it's coming up in a couple of weeks, the next DATCon. The data showed that 85% of the lanes handled 28% of the spend and 20% of the volume, so you were almost spot on there.
Yeah.
And on the other side of the spectrum, 15% of lanes handled 72% of the spend and 80% of the volume.
Yeah, that sounds about right.
Yeah.
Yeah.
So that's kind of a shift, right? Because that's not normally how shippers would have looked at the market before the pandemic, right? They would have just sent everything out to bid.
That's right. Yeah. Yeah. That's what I was mentioning earlier is there used to be this effort to just put everything in the bid and hope it sticks.
Right.
One of the challenges with that is shippers are challenged with being transparent and budgeting with their treasury department, right? And trying to predict, what are we going to spend next year? And if you do that off of an RFP where you've got bids on lanes that may or may not materialize, may materialize 3 weeks later than you predicted, your costs are not predictable. And so you've got some risk on that budget. And so being able to segment this freight into those sparse lanes, like you just broke it out, is perfect. And signaling to your finance department that, this 15% of our spend on these 72% of our lanes has some risk on it. And here's a forecast based on maybe DAT's forecast of what we're expecting those rates to do in the next year on the spot side versus the contract side. Yeah.
I wonder if that's why we're seeing historically high acceptance rates with contract carriers. Because normally in a market like this, you'd expect to see something like 85% acceptance rate. We're seeing much higher, like 95 to 96% acceptance rate. So I just wonder if the ratio between acceptances and rejections is more not so much a reflection of how soft the market is, but there's just less volume going to lanes where there has been historically high rejection rates.
Yeah, I think it's a solid hypothesis. It could be also both, right? I think the soft market's definitely helping in this regard. How shippers tender their freight on lanes that will materialize helps a lot. The amount of freight that we see them intentionally sending to spot instead of going through a routing guide and seeing those rejections is I would agree with you. I think a part of that. Sure.
Because we're in the precarious part of the cycle, right at the bottom of the cycle here, where shippers have had pricing power for quite some time, and carriers have been weathering the storm and pushing back on some of the rate decreases. You've just mentioned the new rate developments coming in close to parity. Yeah. So how would a shipper think about securing capacity, for loads that are going to move in, say, 9 months' time, and in carriers thinking about peak season in the middle of next year, and where rates would be? How do those discussions go? Like, is it?
It goes through the bid process, and unfortunately, the carriers are having to forecast out and hedge some without a completely transparent real-time marketplace, which I don't think anyone really would be in favor of because of the inefficiencies of tendering and all of that would bring. You've got to forecast out, and you've got to hedge some on I'm going to give you a rate today for something that might be worth a lot more than that 9 months from now. Yeah. And the shipper. Yeah, I was going to say the shippers are going to do the same thing internally with their finance team and call out some risk in the latter half of next year.
But they have to be acutely aware that as the market bottoms out, carriers have been exiting, capacity's been realigning. There has to be fewer trucks when this market turns.
Yes. Yeah. Yeah. I think that's definitely the case.
Yeah. Fantastic. All right.
Yeah.
I know you've got to go shortly. If people want to contact you, what's the best way, Chad?
Yeah, on LinkedIn, Chad Kennedy. I'm associated with DAT on LinkedIn. If you message me through there, I'll be sure to get back to you, but I'd love to hear from you.
All right, great. A couple of shout outs on the Freightvine podcast that's out. Great session with Bill Cassidy. Chris Kaplis is talking to Bill Cassidy, senior editor at Journal of Commerce. It's a really good listen. He's been at this for about 30 years. I don't know anybody that's got so much perspective on the ups and downs of the trucking market. Don't forget DATCon is coming up October 22 to 24. You can register at dat.com/DATCon. I'll be on with Jimmy Mack on Radio Nemo, Road Dog Radio, Channel 146 this Thursday at 8 a.m. That's it for this week. Make sure you set up alerts for our live show and subscribe to our channel on YouTube. And with that, another show is in the books. Be safe, be nice to everyone. We'll see you back here next week at 10 a.m. Eastern, 7 a.m. Pacific.